Hello, this is Fran Radano, co-manager of the North American Income Trust, here to talk about performance and the outlook for the 2025 fiscal year. Performance was pretty good in a very volatile market. The share price of the North American Income Trust returned 13.8%, with the discount narrowing down to 4.9%, the tightest it's been in quite some time. From an NAV perspective, the fund returned 8.8%, which outpaced both reference benchmarks, the Russell 1000 Value, which returned 4.9%, and the S&P High Yield Dividend Aristocrats benchmark, which returned 3.1%. From a sector perspective, strong stock selection in both the financials and consumer staples sectors helped propel the portfolio to this outperformance, while industrials was a bit of a laggard. I nailed to Jeremiah to talk about some of the names in the portfolio.
We were really happy with the diversity of the contributors to the performance during the period. Lam Research and Amphenol were two of the top contributors, as both are benefiting from the build-out of AI infrastructure and the need for high-end semiconductors and more memory. Johnson & Johnson was also a top contributor, as the innovation pipelines of both its pharmaceuticals as well as its medtech device portfolios continues to improve and drive an acceleration in growth. Finally, Citigroup also contributed, as strong capital markets trends in global markets, as well as the company's continued efforts around margin and ROE expansion driven by cost and business rationalization, continue to play out. Unfortunately, we still haven't pitched a perfect game yet and had some detractors during the period as well. Booz Allen Hamilton and Accenture were two of our biggest detractors, as shifting U.S. government budget priorities and a reallocation to AI technologies from some of their customers has led to slower than average revenue growth in recent periods, and concerns around the terminal value of the businesses, which has hurt the multiples. Booz Allen has been sold from the portfolio. Zoetis was another detractor during the period due to a slower pace of the growth in the overall animal health market, as well as competitive challenge to one of its large product areas that led to a deceleration in growth. However, we continue to be very optimistic about the prospects of this position. Lastly, Nike also detracted from performance, as the turnaround of their business globally has taken longer than hoped, and external headwinds like tariffs have presented additional pressure to margins. We were certainly active in the portfolio, making changes throughout the period. Two notable additions to the portfolio included Trane Technologies as well as Bank of New York Mellon. Trane, as a commercial HVAC systems provider, is seeing strong demand from the capital spending cycle we are in, including very strong demand from data center growth. Bank of New York, as a service provider to the asset management and banking industries, has seen strong market share gains, a favorable capital markets backdrop, and meaningful productivity improvements, leading to an acceleration in earnings growth from historical levels. Also of note, we did take advantage of the volatility in the first part of the fiscal year around trade relations to add to more cyclical names, given they sold off most during the period, which helped performance in the latter part of the period as those stocks recovered. We did also have some exits from the portfolio. Three notable ones include IBM, Oracle, and UPS. We exited IBM and Oracle due to the concerns around the impact that AI will have on software and IT services businesses, as well as the increasing CapEx spending that has challenged Oracle's balance sheet. We also sold UPS during the period due to competitive concerns and disappointing performance on cost management, as well as concerns around the impact that tariffs will have on the flow of goods. Pass it back to you, Fran, to talk through the outlook.
As we look forward, we look at the current state of affairs. There's a war in Iran going. We have the Fed trying to navigate between their dual mandate of both inflation and employment. And we also need to look at the evolving tariff scenario, as they were struck down. The emergency tariffs were struck down earlier this year. I think when we look at our portfolio, we're very confident in our portfolio. We believe we've built a well-diversified, all-weather portfolio that should hold up in sort of times of volatility. And we believe that these companies are both cash generative and very thorough and strong balance sheets, and will help defend in times of market weakness. As far as going forward, we also want to just reiterate one other bit. From a valuation perspective, the U.S. market has historically been viewed as expensive, currently trading around 21 or 22 times at the broad market level. Importantly, the North American Income Trust, we're very disciplined. We have a best ideas portfolio of 50 stocks, and these stocks are trading on an average multiple around 16 times. They pay a dividend at averages around 3%, and dividend growth, as I mentioned earlier, has been between 6 and 7%. We expect these pillars to continue to be trademarks of the trust, and we expect that going forward this year. Finally, longer term, there was an important fiscal bill that was passed last year that should be emphasized. This fiscal bill incents corporations from a tax perspective to invest in their business through capital expenditures and R&D, and the consumer also has several incremental deductions that they can use to bolster their own personal balance sheets. I think this bill will look back in years as something that was very important and transitional in the U.S. economy and should be a nice intermediate term tailwind for the U.S. And now back to Jeremiah with some final words.
To conclude, as Fran said, we continue to be really excited about the portfolio of companies that we have. U.S. companies continue to drive innovation and productivity through significant investments in technology, including AI, which favors industry-leading companies who have the scale, data, and IT budgets to capitalize on this transformational technology. And we're seeing the benefits across multiple different industries, particularly for large-cap companies who have that scale. We're also excited about the resilience of the portfolio companies that we own. The high-quality nature of the portfolio holdings provides resilience against external challenges that Fran mentioned, like tariffs, energy spikes, and policy changes. The portfolio strategy focuses on companies with robust financial health and consistent dividend growth, which do not heavily rely on macroeconomic conditions for that growth.